Let's create a sustainable, balanced, and growing dividend portfolio that withstands any threat of recession. According to Merrill Lynch, we need 80 to 90% of our annual pre-retirement income to retire comfortably. The total average retirement per year is $47,357. Depending on where you want to live and how extravagantly, this may vary. Let's have a $50,000 per year in dividend income goal for early retirement. Since we want to retire early, we will have a 10-year time horizon. You may adjust this depending on your income. Also, depending on your risk tolerance, you may want higher yields. Just be careful not to fall for unsustainable dividend yield traps. These pesky companies usually have poor management, low revenue, and a dangerous high payout ratio. First, we add 30% into safe dividend ETFs. This would include Vanguard's ticker symbol VYM or Schwab's SCHD. I have a link in the description below of the top 4 dividend ETFs, which include SCHD and VYM, so you can understand exactly why I love these ETFs. Both VYM and SCHD have a very long track record of stock price and dividend growth. Both own very well-known stable companies like Coca-Cola, Verizon, Home Depot, Johnson & Johnson, Bank of America, and AbbVie. VYM has a 2.72% dividend yield, and SCHD has a 3.44% dividend yield. This slice of the pie should consist of stable companies, good capital appreciation, and a nice dividend yield. Second, we would add 30% into monthly dividend income ETFs. These are higher yielding ETFs that pay dividends on a monthly basis. With these ETFs, we need to be careful about capital depreciation. Ideally, we would like a rising stock price with a high dividend yield. This will help fight inflation. I prefer ticker symbol JEPI and DEVO as they have a good track record of increasing stock price, and their expense ratio, while high, is healthy compared to the dividend. Expense ratio is the fee charged to own an ETF or mutual fund because they are actively managed funds, and this covers management and administrative costs. Be careful of high expense ratios as they will eat away at returns. Third, we would add 25% to Dividend Aristocrats or Dividend Kings in different sectors of the market with high yields. Sectors include energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, communication services, and utilities. Top dividend kings would be ticker symbol MO with a 6.7% dividend yield, Legend & Platt with a 4.5% yield, 3M with a 4.1% dividend yield, AbbVie with a 3.8% yield. Top dividend aristocrats would include Walgreens with a 4.4% yield, T. Rowe with a 3.82% yield, and Ben with a 4.64% yield. Fourth, we would add 10% into the housing sector. We will mostly look at REITs or real estate investment trusts. A REIT is in the housing sector and is a company that owns and most often operates income-producing real estate. REITs own many types of commercial real estate, including offices, apartments, warehouses, hospitals, shopping centers, hotels, finance, and forests. If you don't want to worry about researching individual REITs, VNQ, the Vanguard REIT ETF, with a 3.15% yield is a good option. For individual REITs, good options include Realty Income with a 4.1% yield, Vici with a 5% yield, EPR with a 6.2% yield, and Stag with a 4.74% yield. Other types of housing stocks include BDCs and mREITs, which tend to be a bit more complicated and riskier. If you would like a solid BDC or business development company, ticker symbol MAIN is a great option with a 6.62% yield. BDCs invest in small and medium-sized companies and distressed companies. While they help with initial stages of growth and help companies gain financial health, these companies are a bit riskier to finance than sound companies. For mREITs, ABR is a solid choice to buy and hold with a 7.7% dividend yield. It has one of the lowest payout ratios in the industry and has hiked dividends 18% over the past 5 years. mREITs, or mortgage REITs, are companies that are structured as REITs, but they own interest-bearing assets like mortgages and mortgage-backed securities, not physical real estate. They are considered risky because as interest rates increase, mREIT earnings usually decrease due to the borrowing costs. While mREITs generally have higher yields, they tend to cut dividends when times are tough. Last, we add 5% into high-yield dividend stocks in which we have high conviction. These include stocks that are consistently growing revenue and dividends and have a high yield. The stock price is not as important and may be flat. Be careful of stocks that show a decrease in stock price over the last 10 years. High-yield stocks include ticker symbol EPD with a 7.98% yield, Sunoco with a 9.23% yield, ARCC with a 9.15% yield, OHI with a 9.48% yield, and OCSL with a 10% yield. These stocks are risky but offer attractive yields.